is talking or not. I can't hear. Okay, I don't know if Ken is talking or not talking. I can't hear him. Okay, all right. It's okay. Okay, everybody. Okay, okay. Welcome again. welcome, welcome. I'm just putting the chart on. Okay, here we go. Please, okay. All right. So, as I said, welcome everybody. I want to welcome you all and a happy new year. And let me give you a brief. What are we going to do today? This is our 9th year of doing our yearly annual trade planning session. It has been one of the foundations behind our success as traders, and it was also one of the reasons that our 2013 was a banner year for our traders. For those who are joining us for the first time, let me give you a small introduction of what we're going to do today. We have a unique approach to the market which we call price behavior, and in price behavior we are purely use the price as our leading indicators. We don't use any it's basically what we call the approach, back to the future, if you will. We take the old traditional rules of technical analysis, how to apply technical analysis, how to understand the price action. And when I mean price action, I don't mean the volatility, but the understanding the price movement and the tenets of the theories of technical analysis. And we use that in order to identify what we call the high probability trades or the high probability direction. So what we're going to do in order to do that, we have a particular approach to the market, and that approach indicates to us that, as I said, that the price is a leading indicator. And in doing this trade yearly planning session, what we do is we take another aspect or another approach, an additional approach to trading. Idea is to make money in trading, and that approach means that we have to think, be aware of all the fundamentals that's going around us in the world. So we have to think, only to think as fundamentalists, or what is happening in the world around us. We don't dig our head in the sand and say the price is the price. Of course it is. But as I said, we take full account of all the fundamental information that is going around us, but we trade technically. So we think like fundamentalists and we trade like technicians. So what we're going to do, we're going to look at the global markets. We're looking at every currency index. We're looking at the dollar index, the pound, the euro, and so on. We're also going to look at the stock indices. What's happening in the world, in the stock markets, in the various stock markets in the world. What is the economic developments? And we're going to discuss each of those separately, plus what's happening in some of the commodities, because they have a direct effect on the industries. And then after that, we're going to do this in a quick half an hour or so. And then we are going to take every, or what the ones that we select from this planning session as a general guidance for the year. So we're going to pick today the major trends of the year. So this is where you want to align yourself into that direction during the year. And after this, what we're going to do, we are going to try to pinpoint our entry and exits for the coming week. This is something that we do every week, and I invite all of you to join us. And we, in addition to that, we also have some additional upgrades that we have done to our software, which assists us now in, and I'm going to share that stuff with you now. So to start with, we're going to look first at the US dollar. And the US dollar, as of course the dollar is the 800-pound gorilla in the market. It is the biggest economy in the world. And what happens in the United States does what? Okay, is this better? I'm sorry. Is this okay? Can you hear me or you can't hear me now? Hello? Can you hear me or? Okay. So have you heard anything, or was I cut out? Have you heard me, or was it? I don't know. Should I repeat what I was saying? Fine. Okay. So what we're going to do now, as I said, the dollar is what's happening in the United States as the biggest economy in the world, will affect directly or indirectly the rest of the markets. And to discuss what's happening in the United States, basically just to give you a quick wrap around what's happening in the U.S. economy during the last year, there are some very important economic data that has been coming out. First of all, the general ISM, which is the manufacturing index, has come or has been coming quite much better than what's happening in the previous year. This year the index was in November around 57.3, and that is up from 56.4 in October, and it's been moving consistently above the 55%. And this is a good indication that the manufacturing industries or the manufacturing sector in the United States is moving. The second key foundation for the US dollar is the housing market. And the housing market, the CoreLogic, which is the one that produces this information, said that the home price index in October rose 0.2% on a month-to-month basis, and this is very good. In addition, the home price index have increased 12.5% over the whole year, year-to-year, added on a year-to-year basis, and this index has been rising for 20 consecutive months. When we're looking at economic data in a fundamental way, such as employment, housing, manufacturing, you look at these numbers exactly in the same way as you look at a chart, because you're looking for trends. And if now I have a housing number that is rising consecutively 20 months in a row, this means that there is a strong wind behind the housing business, and that is a very important component to the US economy. In addition to that, and to summarize that, I'll tell you how important this number is. Last week, the Federal Reserve Bank reported that the nation's net worth, noted that the accumulated wealth of the Americans have risen to a nominal record high in this past summer. It has risen by $77.3 trillion. It's a staggering number, $77.3 trillion, and it's been moving on an average. And out of the $77 trillion, the stock prices have increased the overall net worth of the Americans by $917 billion, while the home values have added $428 billion. So this tells us that there is, whether you agree with it or you don't agree with it, whatever, I mean, there is a lot of academics, people talk about it, but the numbers, this is the numbers that we're looking for. We're looking for trends in the undergoing in the markets, and we're looking for what's happening in the nation as a whole. In addition to that, there is another number which is quite interesting with regards to the U.S. economy, as you can, which is basically the trade deficits, if you will. And right now, the United States is moving towards energy independence. And if you look at the North Dakota area in the United States, you would see that in the North Dakota they are now producing an average of 941 barrels per day, 941,000 barrels per day of crude oil. And if you look at it, this is just North Dakota, but 941 billion barrels a day, that is the equivalent, that is pretty much the same output that a nation of Qatar is producing. They produce 1 million barrels per day. The whole OPEC produces 30 million barrels per day. Now North Dakota by itself is now coming close to producing 1 million barrels a day, plus that is twice the output of a country like Ecuador. That tells us now that the United States is moving, as I said, to currency independence, and that the importance of this, the United States is the biggest importer. It imports about 33% of its crude oil from Canada and about 47% from OPEC. But the importance of this number is what we call the cash outflow. The cash outflow. When there is an imbalance in trade deficits, the exports are much less than imports. That means that the Americans need to pay for these foreign imports by selling the US dollar and converting it into local currencies. And that capital outflow, what is basically you are selling the dollar, so you're bringing supply to the dollar into the market, thus depressing the dollar, would push the dollar down. Rob has a problem, I don't know, Kathy or so anyway, that of course will mean that they will be selling less dollars, and maybe if you're looking at 40% or 47% of the nation's imports is coming from the OPEC, this is a very good indication that gives us an underlying strength to the US dollar. The one last addition point that I would like to add to the information that I was sharing with you is the United States exports. The exports from the United States have been increasing by an average of 1.8%, and that's equal to $192 billion. And the imports also have been increased by 0.4%. when you have a nation now that is now exporting more than it imports, and at the same time the export numbers are increasing at 3 or 4 times the multiple of what it imports. So you're getting increase in imports and you're getting increase or much bigger increase in exports. That is another indication that the economy is getting strong. The last number that I want to share with you about, again, we do this only once a year, but it's important for us to have this information because it leads us getting into the new year, is you were looking at the unemployment. The unemployment and the employment is key numbers for the U.S. economy. I don't know what somebody's playing with it. The United States non-farm payroll have grown an average of 189,000 jobs each month. This is not as good as it was before, but it is still close to 200,000 jobs a month, and that is, at least we can call it a satisfactory number that would indicate the strength of the U.S. economy. So if we take all that stuff that I said to you, and now we try to apply it to this chart to see what are these numbers, does the chart here concur or confirm these numbers? And based on that, we will take the side or the bias of the market or the currency that would. If you look at this chart, this is the daily chart of the dollar index. And as you can see, this was pretty much, let me put the weekly chart because again, we're looking at, if you look here, you can see that we pretty much have been, for the 2012, we have been trying to break above that structure point, which is around the 81, pretty much right there. That was the intraday structure around 81.90. We did break above it and we have started coming back. That decline did not create a break below the structure point, which this is a major structure point here, which is the 79.34. We have been unable to break below that point because, as you see, if we broke below it before, that was the resumption of the downtrend. And this is the bottom so far, the momentum low of the downtrend, and it's a key issue that we have to take into consideration while we're analyzing this chart. So after it has set in this low in 2011, okay, do you see the chart now? Okay. So this is, as I said, for those who didn't see that, this was the momentum low that was set, and that was the bottom of the bear market. Now, from that time on, it has been moving sideways in what we call a price acceptance zone, and it has failed and tested. It has failed to break below the 79.34, and it has tested it several times. And now it has set for us a higher low, several higher lows, and now this price point over here, which is the 81.74, that would be the interim structure point for the beginning of the trend change. So if the US dollar breaks the 81.74, that would be the beginning of the first push upwards in a new upward trend, and this point is what we call, for most people, the wave of disbelief. And a wave is disbelief is a wave that you get a momentum move upwards, yet the majority of the people do not really believe the genuine or that strength, and they give it different justifications. But for us, that suffices if it gets above the 81.74. This is one of the rules of price behavior that allows us to identify these structure points, and these what we call decision-making points. At that moment, that will be the birth of the new trend, which happens to go in waves. And the next key structure point for the pound, for the US dollar, would be the 85.33. And as you can see, this has been a predominantly very strong area of resistance, and it was also pretty much the structure area over here. So if we are going to take this as the structure point, which is the 85.13, that from here, this we take the bottoms as the structure point. This would be the key for us, that once we break above the 85.13, that would be the beginning of a dollar bull market. So with that, based upon what we see right now, and if we're looking at the year end also is a price behavior indicator. If you look at what happens in the year end, usually at the year end, and this you pretty much see when you're looking at stock indices, but here also it is a seasonal trade, if you will, in all across the board of all indices, especially in a trending market, is that you would see that there will be either a profit-taking exits or a booking of losses. What does that mean? It means that at every year end, all the banks and all the hedge funds and all those financial institutions try to square their books. So if they have profits into something, they would like to book these profits, and therefore if the market is going up, they will start selling. So they do an opposite direction, or it gives you what we call a year-end correction. So they sell if the market is going up, so that they can book their profits and they can request their bonuses and request their management fees. On the other side, they also have losing trades. So what they do is they also close the losing trades. So if you have a position that you're up $100,000 in, and you have another position that you're down 50,000 in, you sell the position that you have 100,000, so now you have $100,000 in profit, but you go to the other position which you're losing 50,000 and you also buy it back to close it. And now you are booking a loss of 50,000, and now you're booking a profit of 100,000, and the $50,000 will offset a portion of your profits. Therefore, the tax bill that you need to pay will only be on the difference between the profit and the losses. So the 50,000 will offset. So that, looking at this at the year end, and you would see that it has ended. This was probably the offsetting at the end of the year. They're trying to close, but this for us is an indication that the sum total of all this action was now to the upside. We closed the week at 80, or the year at 80.95, and the 2-week high, as you can see here, is 81.05. So we're pretty much closed at the 2-week high. That is a strong indicator for us, and therefore we are going to assume a continuous strength, or a continuation of the strength for the US dollar. Bear in mind that we do still have some political situation in the United States, but with that said, we're still going to be looking at the dollar strength to continue, specifically against some of the other weak currencies. So we are going to give a grading system. We use a grading system. So we will call the dollar 1+. We'll give it 1 grade of plus. That means it is strong, but there will be stronger stuff or weaker stuff. So 1 grade is 1+. That indicates that the dollar is strong, and we'll be looking, or our bias for the new year would be buying of the dollar. And if we get above the 81.76, that means that we're beginning a momentum leg to the upside, and of course the bull market will begin above the 85.13. Okay, so we're giving 1 grade of plus to the US dollar. The second currency we're going to look at which is the easy ones, I'm taking the easy ones first, is the British pound. The British pound, as you can see, we have put a bottom back in 2009, and it has been moving in a sideways pattern, creating what we call a trend changing pattern. And a trend changing pattern is characterized by what we call a narrowing, contracting, boring trading, if you will. And you would see that it begins to create higher lows and lower highs, higher lows, and after a big momentum trend to the downside, this kind of action that you see here, okay, I'll post them again, sure. I see them, Sally, so you try again. I hope you see it now. So this narrowing contracting that has been preceded by a major bear market indicates to us that we are now creating what we call a trend changing pattern, and this is what we call a coiling, because it's like a coil, if you will. It creates this, it coils inside those areas, and this is pretty much, as you can see, the coils are getting narrower and narrower and narrower. And once we break, this was the structure point at the 162.92. Once we break, this is the breakout of the coiling, if you will, and that is the beginning of a new trend to the upside. And therefore, looking at this chart, based upon what we see here, this is one of the strongest currency we have out there. And a little bit of fundamental stuff about the pound, so that you can take in the back of your mind, is that the governor of the Bank of England, Mr. Carney, commented on the state of the economy, that the level of interest rates there, he said time and time again that the interest rates is, this is the pound, the British pound, that the interest rate will remain low for quite a long time, and it is all data dependent. But there has been much better employment data coming up, and more better data that is needed so that to push the pound higher. But after he said that the interest rate is going to stay low for a while, he voiced a real concern. He said that he has a real concern that the rising prices of houses and even the speculation, that the rising prices and even speculation in housing in the United Kingdom has reached a certain level that he finds disconcerting. And that remark has allowed the market to perceive, even though he said in a sentence before it that there is no rate change, but that speculation in the housing market and the rise in the housing prices by about 15% over the last year has given the market some indication that the Bank of England may be looking at something in the whatever the market, whatever they perceive, they started buying, and that was the impetus that we needed to break above the structure point. The other thing is, in the United Kingdom, is that the unemployment has fallen quite sharply, surprising everybody in pretty much. It has fallen to a 7.4% in the rolling 3 months to October. And that is down from the 7.6% in the previous month. The sound is terrible. I don't know what I can do. Everybody's... So anyway, the British... Okay, somebody's putting me a signal. Take off the mic, reboost. Okay. The mic pre-boost. Okay. Okay, done. Is this better, guys? Is this better, Terry? Let me pause this for a second because this is important information. Let's continue. All right. Now, I was talking about the unemployment in the United Kingdom. It is down to a 7.4% from a previous 0.6, and the number of British citizens that have been put to work last month rose by 250,000, 250,000, and this is the sharpest 1 month increase since the summer of 2010. This is very impressive, in particular that most of these jobs are full-time jobs. They are not part-time. And the unemployment, in addition to that, has fallen by 99,000, and this too is the sharpest single decline in 1 month from the beginning of this century, in the last 15 years. And with all that information and what we see here technically on the chart, if you look at the daily chart, as you can see, this is your price acceptance. That is the structure, and with that we have pushed higher and we have stayed, as you can see, we broke up this structure with quite decent momentum and this is what we say, that after the news the market was put to bid. There was bid underneath the pound, and don't take the last 2 days of the year as any particular indication that there is a trend change or nothing. These are 2 years where people are squaring their books. The trading desks were pretty much not staffed, and the market would be very volatile. But even if you look at this chart, that is actually a buy signal. This is actually a buy signal. You had a big range day. This is one of our rules in price behavior, a big range day. We had the break in the big range day. We broken down below the big range day to continue in the same direction as the big range day. Then we reversed and we're back above, and we closed back above the previous daily low. That per se is, with all that hoopla that's happening, and we're above the structure point, and we moved above the structure point with momentum. All these are positive indicators to indicate to us that the pound is strong, and that would be one of the currencies that we'll be looking to buy. And with that said, the pound is actually stronger than the US dollar, and therefore we are going to give it, in our grading system, a double plus. So you can use that double plus either in resizing your position and taking twice as much. You have twice the higher probability for the pound to be moving farther and much more stronger than the US dollar. So we'll be looking at, again, giving much more credence to our pound trades, if you will. The next one we're going to look at is the euro, and I'm taking the euro and I'm taking the pound in that sequence for a reason, and that reason is going to be slightly apparent in a minute. First of all, if you look at the euro on a weekly base, before we get to the fundamental stuff, you would notice that we do have a major structure point at 137.37, and that structure point has been working for the last 15 years pretty much. It has been the key level for the euro. What we have, if you've noticed here, that we broke it and we traded pretty much close to 138, and then we retreated below the 37, and as you can see, because these are structural points, you would find that the reaction that follows the failure of a structural points are usually volatile, and you would get those big major move, because this again, if you remember, I was talking about the pound, the wave of disbelief. Well, this is the beginning here. At the moment it breaks this, that is the moment where people begin to change their mind. And I'll show you, because this is quite interesting. It's part of the patterns that we follow in price behavior. When it breaks above the structure here, everybody's committed into that, but some people are not true believers. They see it, they trade like us what they see, they take the trade and they buy it, but suddenly the moment it falters and it turns around a little bit, all these guys say, oh, we knew it is not right. This is the wave of disbelief. So what they happen is they don't believe their eyes, so they start selling to exit their positions, and that creates a major wave, what we call the long liquidation. It's not yet a trend change, it doesn't change, it's just panic because due to the wave of disbelief. This is the wave of disbelief in action. And it continues, and then the market comes back, and again you can see the fear at the second test. Why? Because they got hurt the first time, so now they are very cautious. But once it begins to settle, and this is what's happening right now, it's beginning to settle, and it's sitting at the 135.98 right now after a second, you can see how many failures you got. 1, 2, 3, 4, and the fifth failure it actually capitulates. Now, talking about the euro, why is the euro trading at 138 or reached the point of 139, or now is it trading at 135? Should we be now looking to short the euro? Technically, this looks bad. Why? Because we have a structure point. We had one failure to break above it. We had 2, 3, 4, 5 failures which we broke, and then it came down now, and it is trading below a 2-week low. It took the low of 2 weeks ago, which is 136.25. So technically this is pretty much it's not a trend change, but it's for the short term. We might look for further liquidation in the euro, but our buying point would be at 136.62. The moment it comes back above this will be our buying point. Because why? We have been testing, trying to break the 137 structure. So this, again, we have to take the year end into consideration. We have to take that for the illiquidity of the market. So we have to take this with a grain of salt. But we have to consider now the fundamental story behind the Eurozone. And the Eurozone is unique, if you will, because the economic circumstances that are prevailing in the so-called North in Europe, like countries like Germany, and what's happening in Madrid or Lisbon or Rome or Nicosia, all that stuff that's happening in these countries, which are the ones now that are considered the poor countries, or the ones that have economic weakness in Europe. These two the difference or the separation between the North and South is widening every day. So if you look at Germany, for example, the unemployment there for those who are under 25%, so the unemployment rate for those who are under 25 years of age, I'm sorry, not 25%, 25 years of age, is 8%. Now, you might say, wow, this is high, because I just told you that the British unemployment is 7.4. But if you take that, this is 8% in Germany, and by historical standards, for the last 10 years, this is extremely high for Germany. But if you compare that by the unemployment rate for countries like Spain and Portugal, the unemployment rate for those who are under 25 years is over 50%. So you can see that the dichotomy, if you will, 8% in Germany and 50+% in the eastern part, or in the southern part, what we call the southern part of Europe. So the Germans, and of course they are, I'm going to talk about the Germans electorate, they are taxpayers. They are people that are financially conservative. They are monitoring their economy. They're doing the right things, and they don't feel that they are prepared to give away, or the German electorate is not prepared to give away their treasures to the other countries in what we call the South, knowing beforehand that if they are going to fund these countries, this money is not coming back. Because these nations, by structure or by nature, they're not economically sound, and most of them feel that paying taxes is not prudent. And I was telling them yesterday that one of the ways that the Greek government is trying to find out who has money or who has not paid taxes, they would actually fly helicopters all over Nicosia, not Nicosia, I mean all over Greece, to see who has swimming pools in those houses, and the guys that and didn't report them, because if you have a swimming pool, it's assumed that you have money, and then they go and check your taxes. This is the way now that IIS is doing there, is flying to find who has houses and who has swimming pools. So fundamentally, if you're going to take all that stuff, there is absolutely, we have no understanding why is the euro so strong. Basically, with the majority of the countries in the south, and keeping in mind that a 138 euro rate of exchange is extremely beneficial, or would please the Germans, but yet at the same time it is detrimental to the economic health of the other countries, because it's making all the European products that these countries produce much more expensive, because the euro is therefore expensive. And the only reason that I can bring to you is that the European Monetary Authority has been continuing to do what we call talk the talk of monetary expansion, of funding or financing the economy, but in reality they are not doing anything. Dr. Draghi has not been responsive to the needs of the slower moving economies of Europe, but when he I'm sorry, I was saying he is, I misspoke. He is talking about being responsive to the needs of the slower growing economies. But when push comes to monetary shove, he's actually doing nothing so far. He has talked about adopting something equivalent to the European quantitative easing, but he still did not do anything about it. He has been talking about doing it, but as I said, he hasn't done anything. An interesting remark that he said when he was asked and quizzed about when he was in the meeting last week, but then before the end of the year, before the Governing Council, and the ECB Governing Council, he said that basically they are ready and they are able to act. But when he was quizzed about the possibility that the Eurozone would go into deflation, similar to what's happened in Japan in the last 20 years. This was the key response that he came up with. He said that he does not, and I'm going to read his quote to you. He said, "We do not see a situation like Japan. We have looked at the differences, and the differences are essentially that medium to long-term inflation expectations for the Eurozones are firmly anchored in the case of the Eurozone." So according to him, that the medium to long-term inflation expectations are firmly anchored, while they were not in the case of Japan. And he made it clear that he nor anybody in the council see any deflationary risk that is going to fall upon the European zone. But again, he said that we are going to come in and we're going to do whatever is necessary, but yet he did not pull the trigger. So this means that for whatever reasons he has, we are not, if he doesn't pull the trigger by putting quantitative easing, by technically lowering the euro, I don't think it is required upon us to take one step before Draghi. So once he begins liquidating or quantitative easing, if he doesn't see that threat so far, then there is no reason for us to push towards selling or shorting the euro. So with that said, we are going to filter those last 3 days, and we're going to be looking at the 136.26 as our buying point. And if it gets above it, this will be, we're looking at, once it breaks further or we have a further technical weakness, we're going to look at, but at this point we're going to be neutral to negative on the euro. So this is how we grade the euro. We are going to be negative, slightly bearish, because technically the chart looks bad. We're taking into consideration the year end, but we don't really have a bear signal. All what we have is those 2 days. So we're going neutral with a negative bias. So we're going to be neutral with a negative bias on the euro. Now, quickly we'll go to the Swiss, because that's the easiest. As you can see, if you're looking at this chart, it is pretty much identical to the chart of the euro. They are pretty much in par, moving in the same direction, in tandem. And we have to keep in mind, and firmly in our minds, and firmly in our action, the statements that the Swiss National Bank has made it very, very clear that it has been, this is the statement they said, that it has been and shall continue to actively intend upon defending the 120 rate of exchange to the euro, defending the 120, and shall keep interest rates on hold at or near zero for a long time into the future. And it reiterated that position last week in its quarterly review. And the bank, this is their statement, the bank stands ready to enforce the minimum exchange rate, if necessary, by buying foreign currencies, and listen to this, if necessary, by buying foreign currencies in unlimited quantities, and to take further measures as required. If that was the statement of the Swiss National Bank, I see no reason why we should take any position contrary to that. So we are not going to be touching the Swiss in the short side. And if you look at this chart, if you want to see the central bank in action, the Swiss Central Bank in action, again, this is, if again, when I was talking to you, if you want to look at, think like a fundamentalist and trade like a technician, if you look at this chart, this is the Euro-Swiss chart. You want to see the Swiss bank? Look at this. That is the Swiss National Bank holding from the beginning of 2012 all the way until the end of 2012. You can see for 7 months this thing did not budge below the 120. They have put close to 80, between 60 to 80 billion US dollars in defending it, and that's so if that's the case, we shouldn't fight it. So we're going to come and we're going to give our position to the Swiss. Pretty much they're looking to weaken the Swiss. In the total summary of the discussion, they're weakening the Swiss. So it moves with the euro. So we're going to give the Swiss, again, the same bias of being neutral to negative, and the lead will come from the euro. So these are pretty much the 4 currencies. We're gonna come now to the easy ones. And the easy ones, and the reason I say it's easy because they are the giveaways. They are the ones that are getting to be clear to us now, and we are going to, if you look at the Japanese yen, and as you can see right in front of you, the yen is in a unique situation. The market today, and most of the traders out there, are more and more convinced that the Bank of Japan has much larger job to do than what is being done already in order to inflate. And it's going to do that by inflating its balance sheet and adding more and more and more stimulus into the economy. So even with the Federal Reserve Bank now looking at ways and means to try to taper, what they're doing now in Japan is finding ways and means to expand the bank's balance sheet, and with that, and adding more stimulus. And this takes us to what the Prime Minister of Japan, Mr. Abe, has been saying, that basically he has 3 arrows in his quiver that he's going to shoot. So for those who have forgotten or don't know what those 3 arrows are, first of all, the first arrow is pressuring the Bank of Japan into launching what economists would see as an unprecedentedly aggressive monetary easing, and the setting of the target of 2% inflation. And of course that would hopefully support a 2% increase in the real GDP, or the gross domestic product. The second is a massive deficit financed supplemental government spending focused upon new public works spending. That is adding or making new infrastructure investment that is publicly owned, and they are going to this is going to be massive deficit financed, and it's going to be financed by the government. The third, and pretty much maybe the most difficult and the most harder thing to do, is a program of reforms that is in order to achieve growth through stimulating private investments. And this last one is the toughest of the 3, because the Japanese community is a very conservative community, and it's the least open to fundamental changes. So with that being the toughest, it is easy for him to start issuing the financing, the stimulating the economy, the funding, and the weakening of the yen. And for you guys, looking at the dollar-yen rate today, at somewhere around, as you can see, trading at the 104, and you can see this lovely trend, which most of you or the guys know that we have been long the yen since November of last year, and now it is back at 104. I remember the day when we were trading the dollar yen pretty much at 150 and 160 and 120. This was not far ago. This you're looking at 2008. 4 or 5 years ago, I mean 6 years ago, it was up to 120. And if you want to go back farther, I don't know, unfortunately I don't have much data here, but there was a time, before my time, but the dollar yen, oh, come on, give me a break here. It was up to 150, look at this, 135, 150. So being now at 104, and I have a central banker and a prime minister that have declared their statement, this is what they're doing. And we're going for a 2% inflation that will support a 2% growth in the GDP. It's not just a 2% inflation. They don't want a 2% inflation that will touch the 2% and then roll back to 1% inflation. They want a steady 2% inflation that would support a 2% rate of GDP. In order to get growth in the GDP, there has to be inflation. Inflation is a small rise in prices so people can add to their profits and to their bottom line, the companies. And with that, when Kuroda was asked that the idea of isn't he worried that if he keeps on doing that, there will be inflation coming into Japan? Wouldn't he be concerned and worried about inflation if they push this thing too far, too long? He said it would be much easier for us to handle an inflationary situation rather than handling a deflationary situation. There is no country or economy in the world that wants to go into deflation. It will implode upon itself. But with inflation, there are a million tools at the disposal of the monetary agencies to handle it and to adjust. They're much easier to handle an inflation than it is to handle a deflation. So with that said, we have to take Mr. Kuroda at his word, we have to take Mr. Abe at his word, and we have to expect that for them to achieve this, at least for the next 2 years, we're looking for this thing to come down, to continue, they continue their easing. And if you look at this chart, we are now at 95. The low that was back, which is the 135 I showed you on the dollar yen chart, is pretty much right there around 85, and that would be the target move. We will be coming back to test the low of 2007. So as in the same manner that we took the Swiss National Bank at their word, we are not going to fight central bankers. It is very easy when you're, again, part of price behavior techniques, when you're looking at the central bankers, what they're doing. If you take a situation, again, these are two, let me step back to explain this for a second. If you look at Draghi, what he's saying, he's trying to talk up the currency. He's trying to talk up the euro by saying that he's going to do that, that he's cognizant and aware of what's happening in the slow-growing economy, and so he's trying to talk up the euro. And in the case of the Swiss and the case of the Japanese, they are talking down the yen and they're talking down the Swiss. If I'm going to take one side of those two different central bankers, I will take the side of the central bankers that are talking down their currencies. Because it's much easier for these guys to go and push their currencies down simply by printing more money. All what they have to do is just go to their Xerox machine and start printing money. And they add stimulus to the economies, they push the economies down, and they push it down. But how can you talk up an economy? So if I'm going to take side or you're going to take side with me, we're going to take side with the guys that are talking down their currency, which is we're going to be short the Japanese yen and we're going to be pretty much short the Swiss. With that, if we're going to go back to our chart, we're going to put our grading system for the yen. It's going to be what we call a 3 negative, because it is the very weak, and we are going to stay with the yen, as I said, as the, because we do have a proficient. Okay, last but not two more to go. We're going to talk about the Aussie, and we're going to talk about the Canadian, and we're going to talk about the New Zealand currencies all in one package, because they are combined together in being what we call a commodity currencies. The New Zealand and the Australian and the Canadian are commodity countries, as we know. A good portion of their GDP is products and that they actually export. And once you have three countries, they are bound together by being termed as commodity countries. They share in the good fortune, and also there is what we call negative repercussions, whether there is a fight that comes in between. And what's happening today in Australia is that the GDP, for example, in Australia is growing, but it has grown by a disappointing 0.6%, while people were looking for somewhere for it to be around an 8 or a 9%, and year over year the whole GDP has grown by 2%. So that was very disappointing, and the Australian banker, Mr. Stevens, came out in several press conferences over the last few months, and he again, similar to Kuroda and similar to the Swiss national banker, said that the Australian dollar is too expensive. And if you look at this was the reaction that would happen. And as you can see, the power trend that was up in the Australian dollar all the way from 2009. And to him, this currency, as it stays here, is a very expensive, that the Australian dollar is very expensive, and he's looking towards lowering it by at least 10%. Again, he has a lot of ability to take action, and he said that more than one time, where he's willing to intervene, he's willing to take action, he's willing to intervene into the market, and therefore there is no reason for us to fade as him in this case. We have to take him as his word. As long as he says the Australian dollar is still uncomfortably high, this means that he's going to be pushing this. Now, with that said, something has happened during the month of December which had more negative impact on the Australian dollar than what Stevens had been saying, and Stevens had made more than one press conference. What happened is, and I don't know if you guys know it here in the United States, but what happened is General Motors have decided to close down its factories in Australia because it has now become, and let me read you their remarks, the General Motors remark, that it has become uncompetitive due to the high, or that the Australian dollar is too expensive. The GM decision is much worse blow and it's going to put further pressure upon the other automobile companies that are there to take similar action and to go out. And for them, I was just showing this to the guys, that if here you wanted to buy an Australian GM and you were paying for it 10,000 Australian dollar, at that time, back in 2009, you would have changed that to 4,600 US dollars. So you could have bought a good Toyota or a good GM in Australia in 2009 for the equivalent value of 4,660. Today, at this rate of exchange, it's 1-to-1. Back in 2009, if you had $5,000, you could have bought a car because it was worth 4,660. Now, if you still have your 5,000 car, you can only get a pair of wheels and a spare tire. So nobody's going to buy it from Australia. And that is why the GM and the other company. The same situation, and if you look here, this is now we're sitting at the technical structure point, and a break below that, that will be right here. This, I mean, we can use that. That will be the structural failure for the Aussie, right there. That is the structure point for the Aussie. So below this point here, 87.25 on the index, that thing is going to start the big bear leg, because now we have the technical setup of a failure and we have a structure. So right here, that break, and you can see the fear here, that break is the reason. As soon as it breaks that, we're going to be pushing bearishly on the Aussie dollar. The reason we have this bounce over here, so for those who are saying that bounce, is during last week in the semi-annual appearance for Mr. Stevens before the Parliament in Canberra, he made the remark that at this moment in time there is no material reason for us to cut interest rate further. So that not cutting the interest rate could have been the reason for this bounce, but technically this is ominous, and this is where we're going to be looking at taking it. If you look at the Canadian, it's pretty much the same or worse. As you can see, again, it is the same. If you look at this, it's actually weaker than the Aussie, and that is the structure point. We already broke below the structure point, so that again is an addition. Again, the three of them are commodities, so what we say here goes there for the New Zealand, and there we are below the structure point, so we're looking at selling it. So we'll be bearish. And the last but not least is the New Zealand, and the New Zealand here again suffers from the same impact as, but you can see it's a little bit stronger than the Australian, and this is because also some comments that came up by the Reserve Banker of New Zealand. His name is Mr. Wheeler, and who's the governor of the Royal Bank of New Zealand. He said that 2 weeks ago that the overnight cash rate needs to be up, or needs to be raised to 2.25%. But he also said that this is data dependent and it would be done within the next 2 years. So we just got this bounce. We still don't have any technical reason to actually short it as of yet. It's still in a price acceptance. Technically this is still strong, so we don't have a reason. So we're going to be pretty much neutral to positive on the New Zealand. So to wrap up all the indices and give them our grading system, this is how we are going to be doing it. The pound is the strongest currency, followed by the US dollar, followed by the euro and the Swiss. So these are the ones that we need to be looking at on the buy side. The New Zealand is going to be neutral, but to the leaning towards the positive side. The Japanese yen we're definitely going to be bearish and negative on it. The Canadian, we're going, and the Aussie, we're going to be negative. So the pairs that, or the trends that we're going to be focusing on for the next year, if you will, and this is, we're talking long term here, we'll be looking at being long the pound, long the US dollar, neutral on the euro and the Swiss, but definitely bearish on the Japanese yen, and then the Australian and the Canadian. Adding to those, we have additional confirmations. We're going to take a break in a minute, but additional confirmations that if you look at the stock indices in the world, just give me 1 second. I'm putting the camera back up in a minute, and then we're going to take a break and come and do the if you look at the futures here, at the indices, as you can see, let's take for example the Nikkei. This is the first one we want to look at. It's pretty much, now we're trading at 16,100. It has broken above the momentum high, and as you can see, it is sitting above the 1600 structure point. So now it's starting the next bull leg up, and the significance of this is what Abe has been saying. He's going to weaken, and he's going to force the structural changes by keeping your money at a negative interest rate in the banks. The Japanese people will not keep their money in the banks in cash in order to lose it. So they are going to take that money and put it somewhere else, and that somewhere else is the stock market, the Japanese stock market. And it's the same thing with what's happening here in the United States. Look at the S&P. Look at the Dow Jones. Look at the Nasdaq. Don't look at this last year. This is year end. This is year end portfolio adjustment. So looking at all of that stuff, it is now similar. If you want to short the yen or go long the Nikkei, it's one and the same. It's the same trade, whether you're going short or. So just be careful if you're going to get to trade these indices. If you're short the yen, be careful not to add to shorting because it's pretty much the same trade, so you don't want to be overweighted in balancing your portfolio. But again, they are pretty much the same. If you look at the metals, just quickly, the only one that pretty much we need to be looking at today is copper. It is beginning to break to the upside. So that is something that we need to be looking at. Gold, unfortunately, it's not the time right now. It's still in a bear market. Nothing has particularly changed. It is testing the 1200, but still we're pretty much in a bear market. But it is not time to short the gold. If you wanted to short, that trade is kind of over now. If it trades below the 1200, then we need to see capitulation and liquidation so that we can take it short. So with that, we're going to come to a break. I want you to get some coffee, and these are our positions. As I said, we're going to go long the pound, the dollar, the euro, and the Swiss, and we're going to be shorting the other pairs. This is the macro picture, if you will. We looked at the indices to confirm those analysis, and now we're going to do our entry and exit points. So let's take a 10-minute break, and I'll come back, and we're going to do each currency at itself. Okay, so let's take a coffee break.